Silence for 5 seconds.
Hello and welcome. Today, we're going to tackle a really fundamental question in the world of manufacturing. Imagine a company that produces thousands, maybe even millions, of identical items every single day. Think cans of soda, sheets of glass, or in our case, waffles. How on earth do they figure out what just one of those items costs to make? It's not as simple as it sounds, right? Well, that's precisely what process cost accounting is all about. And we're going to break it down using a very common approach called the weighted average method.
So here's our game plan. We'll start with an introduction to process costing itself. Then we'll compare it to job order costing to really highlight the differences. After that, we dive into the core concept, calculating equivalent units. From there, we'll build the all-important production cost report. And finally, we'll look at cost reconciliation to see how everything ties together. It's a logical flow that will take us from theory right through to application. All right, let's jump right into section 1. So what exactly are we talking about when we say process costing? We're going to define the system and look at its core principles. You might be surprised to see it actually share some DNA with job order costing, which many of you may already be familiar with. So here's the formal definition. A process cost system is the go-to method for businesses that churn out huge volumes of identical products. I mean, think about it. When you're making something like steel or soft drinks or ice cream, you're not making unique individual items. It's a continuous flow of production. It would be impossible and frankly pointless to try and track the specific cost of making that one can of soda. Instead, the whole idea is to accumulate costs for a particular process over a period of time, say a month, and then average that cost over all the units produced. That's the key takeaway here. Now, it's easy to think of process costing and job order costing as complete opposites, but they actually have quite a bit in common. At their core, they're both trying to do the same thing, figure out product costs. So it makes sense that they both track the big 3 manufacturing costs: direct materials, direct labor, and manufacturing overhead. And the accounting flow, the way costs move from raw materials inventory through work in process and ultimately to finished goods, that fundamental journey is identical in both systems. The how is different, but the what and why share a common foundation.
Okay, so with those similarities in mind, let's now really dig into what makes them different. A side-by-side comparison is the best way to see this. Understanding these distinctions is crucial because it shows you exactly why a company would choose one system over the other.
This table really lays it all out beautifully. Let's look at a few key features. First, work in process inventory. In a job order system, you have one account, but in a process system, you'll have multiple WIP accounts, one for each department or process. So you might have a WIP mixing account, then a WIP baking account, and a WIP packaging account. See the difference? And look at the documents. Job cost sheets are out, production cost reports are in. Costs are determined for a whole period, like a month, not for a single job. And here's the big one, the unit cost calculation. This is where we see that term EU, or equivalent units, pop up. It's a completely different way of thinking about unit cost, and it's what we're going to spend a good chunk of our time on next.
All right, section 3. This is where things get really interesting. We've arrived at what is truly the heart of process costing, the concept of equivalent units of production. Now, this might sound a little abstract at first, but trust me, it's the absolute key. It's the magic ingredient that allows us to make sense of a factory floor where you have thousands of items all at different stages of completion. So, what in the world are equivalent units? Let's use an analogy. Imagine you're building cars. At the end of the month, you have 100 cars that are completely finished. And you also have another 10 cars on the assembly line that are exactly halfway done. The question is, how much work did you do? Well, you did the work for 100 finished cars, plus the work for 10 half-finished cars. Those 10 half-finished cars represent the same amount of effort and resources as 5 fully finished cars, right? So, your total output in terms of work done is 105 equivalent units. It's a way of restating partially completed units in terms of fully completed ones. This is absolutely essential for figuring out a fair cost per unit.
Theory is great, but let's put this into practice with a case study. We'll be looking at the mixing department of the Williams Waffle Company for the month of June. Let's walk through this data. They started the month with 100,000 units already in process. Then they started another 800,000. So in total, they have to account for 900,000 physical units. By the end of June, 700,000 were finished and transferred out, leaving 200,000 still in the mixing process. Now here's a critical detail. Look at the percentages of completion for that ending inventory. The materials are 100% complete, meaning all the waffle mix has been added, but the conversion costs, that's the labor and overhead for mixing, are only 60% complete. This distinction is vital, as we're about to see. So, how do we use that data? The formula, when you use the weighted average method, is actually quite straightforward. You take the total number of units that were fully completed and transferred out, and to that you add the equivalent units that are still sitting in your ending work-in-process inventory. It's a simple addition, but you have to calculate that second part correctly. Okay, let's plug in the numbers for Williams waffle. And remember that key detail about different completion percentages? This is where it matters. We have to do this calculation separately for materials and for conversion costs. Let's start with materials. We have 700,000 units that were completed and transferred out. To that, we add the ending WIP. That's 200,000 units, and they are 100% complete as to materials, so that's another 200,000 equivalent units. 700,000 plus 200,000 gives us a total of 900,000 equivalent units for materials. Simple enough. Now for conversion costs. Again, we start with the 700,000 completed units, but this time the 200,000 units in ending WIP are only 60% complete, so 200,000 times 60% is 120,000 equivalent units. Add that to the 700,000 and we get a total of 820,000 equivalent units for conversion costs. Two different answers, and both are correct. Excellent. Now that we've done the heavy lifting of calculating our equivalent units, we're ready for the main event. We can now assemble the single most important document in a process costing system, the production cost report. This is the grand finale, where we synthesize all this data about units and costs into one coherent statement. And preparing this report isn't a random exercise. It's a very methodical four-step process. Step 1, calculate the physical unit flow. Step 2, calculate the equivalent units. Step 3 is where we bring in the money. We calculate the unit production costs. And finally, step 4, we prepare a cost reconciliation schedule to make sure everything balances. The great news is we've actually already completed the first 2 steps. Right, just to formally check those boxes. Step 1, the physical unit flow we know is 900,000 units, and step 2, we just calculated our equivalent units, 900,000 for materials and 820,000 for conversion. So with the quantities sorted out, it's time to bring in the dollars and cents. Okay, on to step 3, which is all about costs. First, we need to figure out our total costs to account for. With the weighted average method, this is very direct. We simply take the costs that were already in our beginning work-in-process inventory and add them to the new costs incurred during the current period, in this case, June. So for materials, we have the initial $50,000 plus the $400,000 added in June for a total of $450,000. For conversion costs, it's $35,000 plus $170,000, which gives us $205,000. That means the grand total costs we must account for this month is $655,000. Now that we have the total cost for materials, we can calculate the cost per equivalent unit. This is a crucial step. We take that total materials cost, the $450,000, and we divide it by the total equivalent units for materials we calculated earlier, which was 900,000. And the math is quite neat. $450,000 divided by 900,000 gives us a cost of exactly 50 cents per equivalent unit for materials. And we just repeat that exact same logic for conversion costs. We take our total conversion cost pool, the $205,000, and we divide that by its corresponding number of equivalent units, which was 820,000. So, $205,000 divided by 820,000. That gives us a unit cost of 25 cents for conversion. So now we have our 2 building blocks. We have the material cost per unit and the conversion cost per unit. To get the total manufacturing cost per equivalent unit, we simply add them together. So that's 50 cents for materials plus 25 cents for conversion, giving us our magic number, 75 cents. This is the total cost for every single fully completed unit of work done in the mixing department. And that brings us to our 5th and final section, which is all about step 4 of the report, cost reconciliation. This is the moment of truth. This is where we take our unit costs and use them to assign the total $655,000 to the units we produced. We need to make sure every single penny is accounted for, either in the goods we finished or in the goods still left in inventory. Let's take a look at this cost reconciliation schedule. First, we account for the costs of the units that were completed and transferred out. We finished 700,000 units, and we know the total cost per unit is 75 cents.
So 700,000 times $0.75 gives us $525,000. That's the cost of the finished goods. Next, we have to value the work in process inventory at the end of the month. And here we have to use our component costs. For materials, we had 200,000 equivalent units, and the material cost was 50 cents per unit. That's $100,000. For conversion costs, we had 120,000 equivalent units at 25 cents each. That's $30,000. So the total cost of our ending WIP is $130,000. Now, for the final check. What's $525,000 plus $130,000? It's $655,000, and that, you'll recall, is the exact total cost we needed to account for. Everything balances perfectly.
This bar chart gives us a really clear visual breakdown of that reconciliation. You can see the entire pool of $655,000 in costs being split into two buckets. The vast majority of it, the $525,000, flows out with the completed goods to the next department or to finished goods inventory. The remaining slice, that $130,000, stays behind as the value of the partially completed work still in the mixing department. It's a very intuitive way to see the cost allocation. And here it is, the complete production cost report for the Williams Waffle Company. This one document synthesizes everything we've just done. You have the quantity schedules at the top, showing both physical and equivalent units. You have the cost calculations in the middle, culminating in that all-important 75-cent unit cost. And at the bottom, you have the final cost reconciliation we just walked through. It's a comprehensive, powerful tool that tells the complete financial story of the mixing department for the month of June. Which leads us to our final, and perhaps most important question. So what? Why go through all this trouble? Well, this report is so much more than an accounting exercise. For a manager at Williams Waffle Company, this is a powerful control tool. By comparing this report month after month, they can evaluate performance. Is the cost per unit creeping up? Why? A spike in conversion costs might mean a machine needs maintenance or that labor is being used inefficiently. Is material cost rising? Maybe it's time to renegotiate with suppliers. This report turns raw production data into actionable intelligence, allowing managers to control costs, improve efficiency, and make truly informed decisions about their operations.